In this month's Economic Update, Kaplan Professional Education's Victoria Papandrea speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's June Economic Update. I'm Victoria Papandrea and today I'm speaking to BT Financial Group's Chief Economist, Chris Caton. Chris, thanks for joining us today.
Oh, it's my pleasure.
Chris, let's start with Europe. Now, the possibility of Greece exiting the eurozone is being openly talked about by European officials. What's the likelihood of this occurring and what impact would it have on a global scale?
Nobody wants Greece to leave. The risk, of course, is that the left-wing parties form a government in mid-June and during the subsequent process of trying to negotiate the austerity and the debt repayments with the Troika, the ECB, the European Commission and the IMF, that those negotiations deadlock at some stage. Capital flows out of the Greek banking system. The Greeks step in to stop that happening, and immediately that happens, they've left the euro because suddenly a euro in Greece is no longer the same as one outside of Greece. It's estimated that the probability of Greece leaving the euro by the end of this year is somewhere close to 50%. I think it may be a bit less than that because nobody wants it to happen and extraordinary steps will be taken. If Greece leaves the euro, this is very bad news for the Greeks. Their currency, their new currency, will drop like a stone. And my first piece of advice, therefore, would be if Greece does leave, plan a Greek holiday. It'll be very cheap, just a bit of civil unrest perhaps, but very cheap. The risk is, that contagion takes these problems elsewhere, and the number one source of risk right now seems to be the Spanish banking system. If you get a run on the Spanish banking system, then it'll become a very, very messy situation. My suspicion is they'll find a way to stop this happening. My suspicion is that, yes, there are many countries in Europe in recession right now, but it's not going to be bad enough to spread to the rest of the world. And my suspicion is we will get through this, but there are clearly risks.
Moving to Australia, despite the RBA's concerns about productivity and the need for structural adjustment in the economy, do you think it will be forced to make further cuts to the cash rate this year?
Well, obviously, if the European situation does deteriorate, it will. Almost as an insurance policy, no matter what happens in Australia. But if you just look at Australia's fundamentals right now, they've given the economy a fair hit in terms of reduction of interest rates. They're entitled to wait and see what's happening. Recent news we've had about retail trade, building approvals and the labour market have all suggested that the worst may be past, even in the soft part of the economy. And my suspicion is that the Reserve Bank might hope it's already done. Now, financial markets right now have a further 1% of a cut priced in. I think it's probably best to assume there's going to be another rate cut or two.
And Chris, what's your outlook for the Australian share market over the next 6 months?
Well, 6 months is a lot easier than 6 days or 6 weeks. When I look at the Australian share market, I see something that is fundamentally cheap. And it's cheap in relation to the earnings of the companies in the market. It's cheap because of all the worries that we have, all offshore, of course. In the first 4 months of this year, the cheap share market seemed to be getting some traction. May has been ugly. My suspicion is we can get some traction again. I have not shifted from my end-of-year target for the ASIC 200, and that target is 4,700 points.
How do you see the Australian dollar performing for the remainder of 2012?
Very difficult to say. It's come down a long way. I've been trying to talk the Australian dollar down for about 2 years, having some success finally. It's still way above any concept of fair value. I've actually in recent months adjusted my end-of-year target up to 95 cents. I might have wished I left it at the old target of 90 cents. Now, of course, if Europe does fall completely out of bed, the Australian dollar will drop very quickly and will be in the 80s. Before you can blink. But my suspicion is that finally reality is setting in and the currency is descending. It should continue to descend in an orderly fashion, in my view.
Looking to Asia now, Chris, what are some key challenges facing some of the Asian economies at present? Well,
there are two clear key challenges. One is the extent to which there's a slowdown in China. They're onto this, and China's pretty good at keeping that economy going, but in many of the major cities they do have something of a residential property perhaps bubble is too strong a word, but they do have residential property problems. And of course, if China fades, then that's a big news for all of Asia. The other risk there actually comes once again from Europe. Asia's financial system is relatively immune to this, but European banks finance a lot of international trade, and Asia depends so much on international trade. And that's how Asia got dragged into the GFC, because basically finance for international trade dried up and they lost their export ability to export. That is potentially a big risk for them. Asian share markets, of course, have adjusted sharply downwards just in the past week or two.
Just finally, Chris, the Federal Reserve has recently vowed to spur growth in the US. How do you see its economy progressing over the second half of this year?
The US economy continues to send off mixed signals, but it's also continued to surprise on the upside in recent months. A lot will depend on the employment numbers we get in the next month or two, but I see continued moderate to maybe a little bit better than moderate growth. The next obstacle for the US is actually beyond the horizon you just mentioned. At the end of the year, many of the Bush tax cuts expire, and so if they don't get around to doing something, they're going to have some dramatic fiscal tightening 1 January 2013. Ordinarily, they'd get around to doing something, but it is of course an election year, and they'll be preoccupied with that. And this thing is called the fiscal cliff that they may fall off, and this will become more and more an issue later in the year. But right now, that economy's not doing nearly as badly as people give it credit for. The unemployment rate, for example, has come down significantly in the past year.
Chris, thank you so much for your time today.
Oh, it's been my pleasure.
And that brings us to the end of June PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. I'll see you again next time.